Welcome, curious minds. Today, we're embarking on a deep dive into one of the, well, true titans of cloud computing. Salesforce, that ubiquitous presence known by its ticker symbol CRM. We've meticulously gathered the latest financial research, peeled back layers of their business model, and really analyzed their operational DNA.
Yeah.
Our mission today is clear: to cut through the industry chatter, give you a genuine shortcut to being well-informed, and truly explore what makes this multi-billion-dollar company tick. Or perhaps, what's changing about how it ticks.
Absolutely. And what's particularly fascinating here, I think, is that we're not just going to, present a list of facts.
Right.
We're going to apply a rigorous, value-oriented framework, much like a seasoned investor would,
Yeah.
to understand Salesforce.
Okay.
Think of it as taking the company's pulse, assessing its core health, and truly understanding its, let's say, intrinsic market temperature. This deep dive will hopefully equip you with the tools to analyze Salesforce, and indeed any company, with a critical eye, helping you understand not just what is happening, but maybe more importantly, why it matters for long-term value.
Right. Getting beyond the surface level.
Exactly. We're looking for those deep insights that separate, surface-level understanding from true market intelligence.
Okay, so let's unpack this then with a critical look at Salesforce's latest snapshot. The numbers are often the first place we go, right? But what do the recent earnings really tell us about their current trajectory and, maybe more importantly, perhaps a new identity forming for this cloud giant?
That's a brilliant way to frame it, actually, because Salesforce just reported a remarkably strong second quarter of fiscal 2026. That period ended July 31st, 2025.
Okay.
And they didn't just meet their own guidance. They quite impressively surpassed it on all the major metrics, which isn't just a good sign. It's a very positive signal to investors that management is executing well. And perhaps, more importantly, has a firm grip on the operational levers of the business.
So if we pull back the curtain on those numbers then, what were the standout figures? What really captured this newfound strength you mentioned?
Yeah, let's start right at the top. Revenue. It came in at a robust $10.2 billion.
Okay.
That represents a healthy 10% year-over-year increase.
Pretty solid for their size.
Very solid. And if we adjust for constant currency fluctuations, which can muddy the waters a bit, that's still a solid 9% growth.
Right.
Now, this growth was overwhelmingly propelled by their core subscription and support revenue. That's the vast majority of their business, as we know. That rose 11% year-over-year to $9.7 billion. So that recurring subscription model, it's clearly still the engine driving the top line, and it's running strong.
And on the flip side, profitability. That's crucial for value investors, isn't it? How did they perform on the bottom line?
Profitability was equally strong, I'd say, and maybe even more indicative of this strategic shift we're talking about. They delivered GAAP earnings per share, EPS, of $2.91. That significantly beat the consensus estimates, which were around $2.78.
Great, nice beat.
But here's where it truly gets interesting. Their operating margin. It hit a company record of 22.8% on a GAAP basis.
Wow, record GAAP margin.
A record GAAP margin. And it soared even higher to 34.3% on a non-GAAP basis.
Okay.
Now, this isn't just a quarterly beat. This signals a strong, deliberate, and I think sustained focus on efficiency and fiscal discipline, something we haven't consistently seen from Salesforce in its earlier, more aggressive growth phases.
Right, the growth at all costs era.
Exactly. It really suggests a company that's, well, truly maturing.
That record operating margin certainly tells a story of greater discipline, but for many, myself included, cash flow is kind of the ultimate measure of a company's health. What do we see there?
Indeed, cash flow is king, as they say. And Salesforce is generating substantial cash. This is perhaps one of the most compelling aspects of their recent performance.
Okay.
They are on track for potentially $15 billion in operating cash flow for the full fiscal year 2026. That's a huge number.
15 billion. Wow.
And this powerful cash generation capability is allowing them to do something historically, well, uncharacteristic for them. Return a significant amount of capital to shareholders.
Right, that's the big change.
It really is. In this past quarter alone, they returned approximately $2.6 billion. That included $2.2 billion in share repurchases and about $399 million in dividends.
Okay.
And the truly monumental news, the real headline grabber, they expanded their share buyback authorization by an astonishing $20 billion.
20 billion more.
20 billion more, bringing the total program to a staggering $50 billion.
$50 billion authorized for buybacks.
$50 billion. This isn't just a commitment. It reflects, I think, management's profound confidence in the business's intrinsic value and its newfound dedication to shareholder returns.
Yeah, you can't argue with that number. It's a game changer for how many investors probably perceive Salesforce now.
Absolutely. It signals a major shift in philosophy.
So a $50 billion buyback program, that's a statement, all right? It signifies a profound shift. And despite these changes, focusing more on margins and returns, are they still feeling optimistic about the future? What's the guidance telling us?
Oh, absolutely. The optimism remains, but it's maybe an optimism rooted in a more, shall we say, efficient approach.
Okay.
The company raised its full-year fiscal 2026 revenue outlook slightly to $41.3 billion. And they also boosted their non-GAAP operating margin guidance to 34.1%, so still expecting strong profitability.
Right.
And management specifically highlighted the early success of new AI products. They mentioned one called Agentforce, which apparently already boasts over 12,500 deals.
12,000 deals already.
Yeah, and importantly, they said more than 6,000 of those were actually paid subscriptions.
Okay, so not just trials, real revenue.
Exactly. This rapid uptake suggests that their strategic bet on AI, which is huge for them, is starting to gain real traction. And that's absolutely crucial for driving the next wave of growth and, maintaining their competitive edge.
So we've got the snapshot then. Strong financial performance, a clear pivot towards efficiency and shareholder returns. But for those who might only know Salesforce by its ticker, CRM, what does this cloud giant actually do? How does it generate these billions? And what's the underlying business model that supports it all?
Right, good question. At its core, Salesforce isn't just a software company. It's really the undisputed world's leading cloud-based software provider specializing in customer relationship management, or CRM.
The leader, yeah.
And they deliver their services through that ubiquitous model known as software as a service, or SaaS.
Okay.
So imagine this. Instead of buying a software license and installing it on your own company computers, businesses simply subscribe to Salesforce's applications over the internet.
Right, like renting versus owning.
Yeah, exactly. It's like renting a powerful, constantly updated suite of tools directly from the cloud, accessible pretty much anywhere, anytime.
So it's all about that predictable, recurring revenue stream that, well, so many modern tech companies covet.
Precisely. Their income primarily flows from these recurring subscription fees. That's for their vast array of enterprise cloud applications and the related support services they provide.
Okay.
This subscription and support segment is absolutely dominant. It typically comprises roughly 93% of their total revenue in recent years.
93%. Wow.
Yeah, vast majority. The remaining 7% or so comes from what they call professional services. That's essentially consulting, implementation, training, basically helping customers integrate Salesforce into their existing systems and, maximize its utility.
Kind of the setup and ongoing help.
Exactly. Think of it as the white glove service that helps ensure seamless adoption and value.
And within that massive subscription engine, what are the specific products or clouds, as they call them, that contribute the most to their revenue? Is it all just sales software?
No, not at all. Their offerings are organized into several flagship application clouds, each targeting a specific business function.
Okay.
The Service Cloud, which empowers companies with customer service and support solutions, is currently the largest contributor. That accounts for about 23–24% of total revenue.
Service Cloud number one. Okay.
Following closely behind is the venerable Sales Cloud. That was their original offering, focused on Salesforce automation. That brings in roughly 22%.
Still huge.
Still huge, absolutely. Then you have a category called Platform and Other. This includes the foundational Salesforce platform itself, collaborative tools like Slack, which they acquired.
Right, Slack.
And their App Exchange Marketplace. That whole bundle contributes around 19%.
Okay.
Then there's integration and analytics. This encompasses powerful tools like MuleSoft for integration and Tableau for data visualization. That stands at about 15%.
MuleSoft and Tableau, yeah. Big acquisition.
Very big. And finally, the Marketing and Commerce Cloud contributes roughly 14%. So you see, it's a vast, interconnected portfolio designed to touch almost every aspect of how a business interacts with its customers.
Yeah, so it's far beyond just managing sales leads, like you said. It's a comprehensive platform for the entire customer journey. Who exactly are these customers then? Are they just massive corporations, or is it a broader spectrum?
Their customer base is incredibly vast and remarkably diverse. Salesforce serves over 150,000 business customers worldwide.
150,000.
Yeah. And this ranges from nascent small businesses, just starting their digital journey, all the way up to over 90% of the Fortune 500, the true global behemoths.
Wow, from small shops to giants.
Exactly. This broad applicability really speaks volumes about the platform's scalability and its ability to adapt to different industry needs. And a cornerstone of their growth strategy, something they talk about a lot, is what they cleverly call land and expand.
Land and expand, okay.
This means they often get a foot in the door with a new client, using maybe just one specific product, say Sales Cloud.
Mm-hmm.
And then over time, they strategically cross-sell and upsell additional cloud solutions, new features, or integrate more of their ecosystem like Tableau or Slack.
Right, get them hooked on one thing, then add more.
Precisely. This strategy dramatically increases the revenue generated from each customer over the client's lifetime. It makes their growth highly efficient once a client is onboarded and, embedded in the Salesforce ecosystem.
So a clear recurring revenue model built on a massive, ever-expanding customer base that they can continuously monetize. It sounds on the surface like an impenetrable fortress. But even for giants, there are vulnerabilities, right?
Always.
Which makes the transition to understanding their risks even more crucial. Here's where it gets really interesting, I think. Even with such strong performance and a seemingly robust business model, every company, even a titan like Salesforce, faces challenges. So what are the headwinds Salesforce is navigating? Both maybe in the short term, those temporary gusts, and structurally for the long run, those deeper currents that could reshape its destiny.
Exactly. And understanding these risks isn't just about, being pessimistic. It's crucial for any sound investment thesis and for understanding the strategic decisions a company makes.
Right.
We can effectively break these down into two categories, I think. The more temporary factors that might smooth out over time, and then the more enduring structural challenges that demand continuous strategic adaptation.
Okay, let's start with those short-term, perhaps more fleeting headwinds. What immediate challenges are causing some friction for Salesforce right now, or have recently?
Well, the primary short-term challenge that definitely cast a shadow, particularly back in 2023, was the broader macroeconomic slowdown.
The economy.
Yeah. When corporate spending tightens its belt, you see customers delay deals, scrutinize budgets more closely, and sales cycles just get longer. And this naturally slowed Salesforce's growth from its, prior blistering pace. High inflation, rising interest rates. These things make businesses more hesitant to invest heavily in big IT projects, even essential ones.
Even CRM.
Even CRM Salesforce, despite its market leadership, isn't fully immune to these broader economic forces that can temporarily dampen demand for its products. It's like a powerful ship encountering choppy waters. It can navigate, but it will slow down.
Makes sense. What else in the short term?
Another factor is currency fluctuations, forex risk. Roughly a third, about 33% of Salesforce's revenue originates from outside the U.S.
Okay, significant chunk.
It is. So, for instance, a strong U.S. dollar, which we've seen at times, can temporarily reduce their reported revenue growth when those international sales are converted back into dollars.
Right, even if the business is doing fine locally.
Exactly. Even if the underlying business performance in local currencies is perfectly solid, these foreign exchange impacts are often transient, but they can create unwelcome noise and volatility in quarterly results, making it, a bit harder to assess the core performance sometimes.
Got it. Anything else temporary?
We also observe some significant post-pandemic IT spending shifts. Think about it. After that huge acceleration of digital transformation during 2020-21.
Right. Everyone rushed to the cloud.
Everyone did.
Yeah.
Some of that demand naturally normalized afterward. Plus, budgets shifted towards other critical areas. Maybe cybersecurity became the top priority, or infrastructure upgrades, or even specific industry-focused software.
Okay.
This created some short-term soft spots for Salesforce as IT spending priorities just temporarily realigned across the enterprise landscape.
Interesting. What about internal factors?
Yeah, that's important too. There was the impact of leadership transitions and reorganizations. Salesforce experienced pretty significant leadership turnover in late 2022 and through 2023.
Right. I remember Brett Taylor leaving.
Exactly. The departure of co-CEO Brett Taylor was a big one, along with several other key executives. Now, while Mark Benioff remains firmly at the helm, these transitions undoubtedly caused some internal uncertainty and, frankly, required management bandwidth to stabilize things.
Mm-hmm.
And then there was that major restructuring in early 2023, which included a 10% workforce layoff.
The layoffs, yeah.
That was explicitly aimed at improving margins, which it did. But understandably, it caused momentary disruption to internal operations and maybe sales productivity, even if it was ultimately a necessary strategic move for efficiency.
Okay. And competition, is that more short-term or long-term?
Well, there's a near-term aspect to it. Intensified competitive pressure on deals. This is particularly evident from rivals like Microsoft.
Microsoft, yeah.
They are aggressively bundling their Dynamics 365 CRM with other enterprise products, think Office 365, Azure, leveraging their vast ecosystem, and, frankly, their pricing power.
The bundle is powerful.
It is. This can create pricing pressure or maybe slower win rates for Salesforce, forcing them to fight harder for large enterprise contracts, at least until they can differentiate further with new features, especially, around AI. It's a constant battle for market share.
Okay, so these are challenges that a well-managed, resilient company like Salesforce can certainly weather, and they seem to be adapting. But what about the more structural, long-term risks? These are the deeper currents that could fundamentally reshape its future, right?
This is where the long-term strategic game truly comes into play, I think, and where a company's ability to innovate and adapt is really tested.
Okay.
The most critical long-term risk, hands down, is intensifying competition, especially AI-driven.
AI competition.
Yes. Mega-cap rivals like Microsoft, Oracle, SAP, Adobe, they aren't standing still. They're all deepening their CRM and cloud offerings. They're embedding AI capabilities at a rapid pace.
Right. Everyone's talking AI CRM now.
It's exactly. Microsoft's Dynamics 365, for example, leveraging Azure AI and OpenAI integrations, poses a formidable threat. It can feel like a direct assault on Salesforce's core market. So if Salesforce's own AI innovation falters, or maybe if it doesn't deliver meaningful, tangible ROI for customers by, say, 2027, which is roughly management's stated timeline for major AI financial impact, then market share could certainly be chipped away.
That's a big if.
It is. Plus, you've got smaller, specialized SaaS firms continuing to emerge and expand, targeting specific niches that maybe Salesforce traditionally overlooked. The competitive landscape is just getting more complex.
Okay, intense competition. What else structurally?
Another structural concern for any mature large company is market saturation and slowing growth. We talked about their growth moderating to high single digits, 8–10% for the FY 2026 outlook.
Right. Not the 20–30% of the past.
Exactly. The law of large numbers is an unavoidable reality for a company pulling in over $40 billion in annual revenue. It's like a marathon runner who was once sprinting. It's just much harder to maintain those hyper-growth rates when you're already covering such a vast market.
Makes sense.
This slowing growth is a core concern for investors historically accustomed to Salesforce's double-digit rates. So to avoid long-term stagnation, Salesforce needs new, powerful growth vectors, maybe expanding into new industry-specific clouds, or deeper international penetration, or again, successful AI monetization.
So finding new avenues for growth is key. What about execution? They've made some huge acquisitions.
That's another big one.
Yeah.
Significant execution risks related to integration and innovation. Salesforce has grown immensely through large, often multi-billion-dollar acquisitions, MuleSoft, Tableau, Slack.
Right, big names.
And integrating these complex businesses into a truly cohesive platform, ensuring they work seamlessly together and actually extracting the promised synergies is a continuous challenging task. It's not easy. A recent example is the announced, though possibly facing hurdles, $8 billion deal for Informatica, a data management firm. That's intended to significantly boost its AI capabilities. But integration missteps can distract management, they can dilute margins, and they can slow down critical innovation elsewhere. So the company must continually innovate, especially around AI features that genuinely enhance customer experience and productivity, just to remain relevant and justify its premium pricing.
Integration is always tricky. What about external pressures like regulation?
Definitely a factor. We have to consider regulatory and data risks. As a custodian of vast amounts of sensitive customer data across, hundreds of thousands of businesses.
Yeah, tons of data.
Salesforce faces increasing regulatory scrutiny around data privacy. Laws like GDPR in Europe, CCPA in California, they're constantly evolving, and compliance costs are only rising. And any major data breach, or importantly now, perceived misuse of AI capabilities could severely damage customer trust, which is arguably a company's most valuable asset. And while it seems distant now, antitrust scrutiny could also become a factor if they pursue another colossal acquisition, given their already dominant market position. It's something to keep an eye on.
Okay, and technology itself changes.
Always.
Yeah.
That's the ever-present threat of changing customer preferences. Technological paradigms are not static, they shift. If new approaches like, say, low-code platforms become dominant, or hyper-personalization takes off in unexpected ways, or maybe even open-source CRM gains traction in the enterprise, Salesforce must be agile enough to adapt.
Right.
The company is currently betting heavily on AI to augment its software, strategically repositioning itself as the #1AI CRM. Failing to anticipate and pivot to the next big technological wave, like what happened to some legacy software firms during the cloud transition, is an existential long-term risk for any tech giant.
Yeah, you can't miss the next big shift.
You can't. And finally, something we touched on earlier, the increasing pressure from shareholder activism and governance concerns.
Right, the activists.
In early 2023, those activist investors, Elliott Management, Starboard Value, Value Act, acquired significant stakes and pushed aggressively for higher margins and reduced spending. Now, while Salesforce responded decisively, these activist voices remain vigilant. And a clear signal of broader shareholder dissatisfaction was when that majority of investors voted against Salesforce's executive pay plan in 2024.
Yeah, the pay vote.
It emphasized the need for better alignment of management incentives with sustained, profitable shareholder value creation. That pressure is likely to remain.
So it's a really dynamic and challenging landscape then. You've got global macroeconomic forces converging with intense competition, the absolute imperative for continuous smart innovation and increasing demands from shareholders.
That sums it up well.
Understanding these multifaceted risks truly underscores the importance of having a clear, adaptable strategy. Okay, let's dive deeper now into how Salesforce actually operates. Let's explore their cost structure. Where does the money truly go after those massive subscription revenues come rolling in? And importantly, how is that changing in this new era of efficient growth you mentioned?
Right. Salesforce operates with what we'd call a classic software business model. Fundamentally, it's characterized by very high gross margins, which is great, but also, crucially, significant operating expenses.
Okay.
Those are primarily concentrated in, number one, sales and marketing, and number two, research and development. It's a model really built on achieving scale.
High gross margins, that's a phrase we hear a lot with SaaS companies. Can you maybe just break down what that actually means for Salesforce?
Certainly. It means that the direct variable cost to deliver their cloud services, things like data center hosting, maybe some basic customer support for the core product, any third-party license royalties they might pay, that cost is relatively low per additional user or customer.
Okay. Low incremental costs.
Very low. Salesforce's gross profit margins are typically around 75–78%.
75 to 78%, that's huge.
It's phenomenal. It means that for every dollar of subscription revenue they generate, only about 22 to 25 cents are consumed by those direct costs.
Wow.
This is a true hallmark of the software-as-a-service model. It provides powerful economies of scale because serving an additional customer or user on their multi-tenant cloud infrastructure doesn't add a lot of direct incremental cost. Once the platform is built, each new subscriber is highly profitable, at least at the gross margin level.
That's a very strong foundation then. So if those direct costs are relatively low, where do the larger expenses come into play? What eats into those impressive gross profits?
Yeah, the big spenders for Salesforce are squarely in the operating expenses category, or OpEx, and these often determine their ultimate profitability.
Okay.
Sales and marketing, S&M, has historically been Salesforce's single largest operating expense category.
Sales and marketing, number one.
By far. In fiscal year 2023, for instance, it was over $13 billion. That consumed roughly 36% of their total revenue.
36% on S&M.
Yeah. And in prior years, during its hyper-growth phase, it was often even higher, maybe 45–50%.
Wow.
This budget is heavily weighted towards personnel. That's the salaries and commissions for their massive global sales force and extensive marketing programs. Think about their huge, immersive Dreamforce conference.
Right. Dreamforce is massive.
It is. It's essentially the cost of acquiring new customers, expanding relationships with existing ones, and just maintaining their brand dominance in a highly competitive market.
Okay, so S&M is the biggest piece. What about investing in the future, like research and development? That's got to be significant for a tech leader.
Absolutely. Research and development, R&D, is the second largest expense category.
Yeah.
In FY 2025, it stood at about $6.0 billion. That represented roughly 16% of revenue.
16% on R&D.
Yeah. This covers the salaries of thousands of engineers, product developers, AI researchers, the people crucial for continuous innovation, developing new features, and keeping the platform at the cutting edge, especially now in areas like generative AI.
Right. Got to fund the AI race.
Exactly. While R&D is considered more of a fixed cost in the short term, it's a vital strategic investment to stay competitive, drive future growth, and differentiate against those mega-cap rivals we discussed. It's not directly tied to the number of customers served today, but rather to the company's commitment to advancing its technological prowess.
Got it. What about the other costs?
General and administrative G&A costs are smaller in comparison. They typically range from 8–10% of revenue. This covers corporate overhead like finance, legal, human resources, executive management, the cost of running the corporation itself. And capital expenditures, CapEx, are relatively modest compared to revenue, usually around 2% in FY 2025. This is primarily for data centers and IT infrastructure. Salesforce isn't an overly asset-intensive business in the traditional sense, which is generally seen as a positive from a capital efficiency perspective.
So when you break it down like that, it really boils down to people, doesn't it?
Yeah.
The bulk of their cost is essentially human capital, the sales force, the marketers, the engineers.
You've absolutely hit the nail on the head. The single most significant cost for Salesforce is indeed personnel. Salaries, commissions, stock-based compensation, which is a big non-cash expense for them, for its approximately 76,000 employees. That's the overwhelming expense category.
Right.
Salesforce essentially spends heavily to acquire and retain top talent, to acquire customers through that sales force, and to develop cutting-edge products that maintain its market leadership. Their intellectual property and their human capital are their most valuable assets and therefore also their largest expenses.
Okay. Now, you mentioned earlier that Salesforce has been consciously moving towards efficient growth, especially after that activist investor pressure. How has that mindset shift specifically impacted this cost structure we just outlined? It sounds like it must have been a significant change.
It was a very significant change, and it truly highlights management's agility or perhaps responsiveness under pressure. Salesforce deliberately pivoted from that growth at all costs mentality to an efficient growth mindset, particularly after the activist pressure ramped up in 2023. And this wasn't just talk, it involved concrete actions. Most notably, that significant 10% workforce layoff impacting about 7,000 employees globally.
Right, that was big news.
It was. And they also implemented a freeze on major hiring. This was a very public and impactful adjustment to their fixed costs, primarily personnel costs.
And the result?
The result has been dramatic. A substantial expansion of their GAAP operating margin, soaring from just 2% in FY 2023 to that robust 19% we saw in FY 2025.
Wow, 2% to 19% GAAP margin in 2 years.
Exactly. It proves management's ability to adjust these large, labor-centric fixed costs during slowdowns or when prompted. They can effectively leverage those high gross margins to translate more of that top-line revenue into bottom-line profit when they choose to or need to.
Right.
So in high-growth periods, they've shown they can invest aggressively, which compresses margins. But in tougher economic times or under investor pressure, they've now proven they can pull back, reduce or slow cost growth, and boost profitability. That's a key sign of a maturing and arguably more disciplined company.
That's a clear demonstration of financial discipline and responsiveness to shareholder demands. Oh. Okay, shifting gears slightly, what about the people at the helm? How stable and aligned is Salesforce's leadership as they navigate these complex dynamics we've been discussing?
Yeah, management and governance are undeniably key to steering such a large and complex ship through these waters. Mark Benioff, the co-founder, chair, and CEO, remains the iconic leader. He's been there since 1999. He's not just a CEO, he's really the visionary public face of the company, consistently driving strategy, especially around growth and new initiatives like AI.
Right. He's synonymous with Salesforce.
It really is. And importantly, he also retains a significant personal stake, approximately 2.3% of shares as of 2025. That strongly aligns his personal financial outcomes with those of other shareholders.
Okay, good alignment there. Who else is key?
Other key figures include Robin Washington as president and Keogh CFO, bringing a wealth of financial experience. And Parker Harris, the other co-founder and CPO, is still deeply involved in the technology direction. The board of directors also includes figures like Mason Morfitt from the activist fund Value Act Capital.
Ah, the activist on the board.
Exactly. He joined as part of those earlier activist discussions, ensuring those shareholder perspectives are well represented right at the top.
What's their track record been like in terms of performance and maybe transparency? Have they generally delivered on their promises?
Management has a proven track record of, well, aggressive goal setting and generally meeting or in many cases recently exceeding guidance.
Okay.
For instance, after promising a 25% plus non-GAAP operating margin by FY 2026, they were already hitting 34% by mid-2025, far surpassing that initial goal.
Right. Blew past that target.
Yeah, suggests strong execution on cost control and strategic initiatives. On transparency, they've been quite candid about broad challenges, like openly acknowledging some sales execution issues back in 2022.
Mm-hmm.
However, they've sometimes been less specific on certain granular metrics. For example, they stopped reporting precise customer counts after 2016, and getting detailed acquisition integration costs can sometimes be tricky for external analysts trying to fully dissect underlying trends.
Okay, so mostly transparent, but some details are harder to get.
Generally, yes.
Yeah.
That said, crucially, there haven't been any serious allegations of financial misconduct, which is obviously paramount for investor trust.
Absolutely. And what about that notable event you mentioned earlier, the shareholder vote on executive pay? What did that signal about how shareholders view their leadership?
Yeah, that was a very notable event. The majority vote against Salesforce's executive pay plan in 2024.
54% against, you said.
54%. This wasn't just a minor dissent. It signaled clear, widespread shareholder concerns about executive compensation levels, particularly for Mark Benioff. And it highlighted a collective desire for better alignment of management incentives with sustained shareholder value creation.
Right.
Now, while the vote was technically advisory, meaning non-binding, it carries substantial weight and public relations implications.
Yeah.
It definitely demonstrates active shareholder engagement.
Sends a message.
It sends a message. However, as I mentioned, Benioff's substantial equity ownership does naturally align him with shareholder outcomes to a large degree. And the company is also known for its distinctive ohana culture, that philosophy rooted in the Hawaiian concept of family and community, which they try to extend to employees, customers, partners, alongside its strong ethical initiatives.
Right. The ohana culture is well known.
It is.
Yeah.
And while there was higher executive turnover around 2022, the company seems to have stabilized the team since then, often promoting internally or bringing veterans back, with Benioff's enduring presence providing that strong sense of continuity and strategic direction.
It certainly sounds like a founder-led company that has demonstrated, perhaps partly prompted by activists, a willingness to be responsive to investor calls for greater discipline and financial transparency, even on sensitive issues like executive compensation. Okay, now let's turn our attention specifically to the people who truly own Salesforce, the shareholders. Who are they, broadly speaking, and how have they been influencing the company's strategic direction, especially concerning something as fundamental as capital returns? This feels like where the rubber truly meets the road for how value is created and distributed back to owners.
This is a profoundly crucial area, you're right. As shareholder influence has visibly and dramatically reshaped Salesforce's recent actions, it's marked a significant, almost unprecedented pivot for the company. Understanding these dynamics is really key to seeing where the company might be headed.
So who are the biggest players in terms of ownership? Are we talking about a diverse group, or is it concentrated with just a few dominant institutions?
Ownership is overwhelmingly dominated by large institutional investors. You can pretty much think of the big three index fund firms, Vanguard Group, holding about 9.2%, BlackRock with approximately 8.4%, and State Street holding around 5.1% as collectively commanding over 20% of the stock.
Wow, over a fifth just between those three.
Yeah. These are largely passive funds, meaning they don't actively pick stocks based on fundamentals.
Yeah.
But their sheer size gives them immense voting power and therefore significant influence on governance matters like board elections and executive pay.
Right, passive giants with active voices sometimes.
Increasingly so. Beyond them, other large active managers like Fidelity and T. Rowe Price also hold significant stakes, contributing to a diverse but definitely institutional-heavy ownership base.
And what about activist investors? We hear a lot about them shaking things up and forcing change. Were they a major factor here? You mentioned them earlier.
Indeed, activist investors were a huge factor. They really acted as a catalyst for much of the change, particularly the efficiency drive and capital return shift we've discussed. In early 2023, several prominent activist hedge funds, including Starboard Value, Value Act Capital, and Elliott Management, acquired significant stakes.
Big names in activism.
Very big names.
Yeah.
And they didn't just quietly buy shares. They actively engaged management, pushing relentlessly for changes, particularly around margin expansion, increased profitability, and a more disciplined capital allocation strategy, basically. Stop spending so much, return more cash.
Right.
And as we noted, Value Act Capital even secured that board seat for its CEO, Mason Morfitt, which provided a direct channel for influence right inside the company's highest decision-making body.
How did these shareholders, particularly the activists, manage to exert their power? Did it come down to a contentious proxy fight, or was it more behind-the-scenes pressure?
It was a very intense period, definitely. But it ultimately averted a full-blown public proxy fight, which can get ugly. Instead, it seemed to be a sustained, concentrated campaign of pressure and dialogue. And that very strong signal was sent to the 2025 annual stockholders system, meeting with that majority vote 54% against Salesforce's 2024 executive pay plan.
That pay vote again, yeah.
That was a clear rebuke, driven largely by proxy advisory firms like ISS and Glass Lewis recommending against it. And it showed that even those large, typically passive funds like Vanguard and BlackRock were willing to assert their governance concerns by voting against management on pay.
Sends a strong signal, even if it's non-binding.
Absolutely. While such votes are advisory, they carry substantial weight and public relations implications. However, it's also important to note that shareholders did re-elect all board nominees, including Benioff, with broad support. This indicated general confidence in the board's overall direction, especially after the activist settlement led to those concrete changes in strategy.
Okay, so the activists didn't get everything they wanted, perhaps, but they certainly drove change. What were the tangible, real-world outcomes of this activism and broader shareholder pressure? How did it reshape Salesforce's operations and financial strategy?
Well, by late 2023, the activist funds were largely expressing satisfaction, at least publicly. They had seen Salesforce implement significant cost-cutting, the layoffs, dramatically expand its buyback authorizations, initiate a dividend, and add new independent directors to the board.
Right.
This proactive response by management effectively averted those potential proxy fights and demonstrated a clear willingness to engage constructively with its most significant shareholders. But the most monumental, the truly transformative shift, which really ushered in what many see as a new era for Salesforce, is in its capital return policy.
Okay, let's focus on that.
This wasn't just a tweak. It was a fundamental reorientation of their financial philosophy.
Tell us more about that, because Salesforce was historically known for reinvesting virtually everything back into growth, often through acquisitions, right? This sounds like a complete reversal.
Exactly. That's the perfect way to put it. For years, Salesforce epitomized that growth at all costs philosophy. They prioritized market share and top-line expansion above almost everything else, including reported profits or returning cash. But that has fundamentally changed. Salesforce initiated its first-ever share repurchase program only in 2022, starting with a $10 billion authorization. That alone was unprecedented for the company.
Just starting in 2022.
Yeah, very late compared to other large tech firms. Then, in early 2024, it was expanded by another $10 billion. But the really big news, the truly eye-popping figure that signaled this new phase, came in September 2025. A further $20 billion increase.
Bringing the total
authorized buyback program to that staggering $50 billion.
$50 billion! That's incredible.
It's a massive authorization. It represents over 20% of the company's current market capitalization. And it's just a stark contrast to the prior decade where Salesforce virtually didn't repurchase stock. In fact, its share count often rose significantly due to its aggressive acquisition strategy using stock.
Right, dilution was common.
Very common. Now, we are actually witnessing the share count begin to decline, indicating a genuine commitment to using buybacks to enhance shareholder value, not just offset dilution.
And what about dividends? You mentioned those too. Is that also part of this new, more mature approach to capital allocation?
Yes, absolutely. The company also initiated its first ever cash dividend in 2023.
First dividend ever in 2023.
That's right. It started modestly at $1.15 per share quarterly, but it has since been raised to $1.22 per share quarterly as of Q2 fiscal year 2026.
Okay, so growing the dividend too.
Growing it, yeah. Now, while it's still modest in terms of yield compared to, say, some mature industrial companies, this dividend symbolizes Salesforce's new phase as a truly cash-generative company. It shows they're now willing to directly reward shareholders with consistent cash payouts. This is a notable departure from its history and signals a shift to a much more balanced approach between reinvestment for growth and direct returns to owners. Management has stated the buyback program is more opportunistic, used to offset dilution and return excess cash when the price is right, while the dividend signals a more mature, consistent return commitment to shareholders. It really solidifies this new identity.
This is truly a significant pivot, as you said. It marks a clear transition from a growth-at-all-costs philosophy to a more mature, shareholder return-focused approach. It fundamentally changes how one might view the company's long-term value proposition and maybe even its valuation multiple over time. Okay, this is where we really roll up our sleeves and apply a, let's say, stringent framework. We're going to put Salesforce through a Buffett-style checklist.
Like gauntlet.
Exactly. This isn't just a casual glance. This framework is designed to help us gauge a company's fundamental strength, its economic moat, as Buffett calls it, and its overall value proposition with the same kind of discerning eye that Warren Buffett and Charlie Munger famously apply. Think of it as using a sophisticated diagnostic tool, maybe like that Buffett Indicator app people use for the whole market, but applying similar principles to measure the intrinsic health and sort of market temperature of this one particular stock.
Indeed. The goal, as Buffett puts it, is to identify great companies at a great price. It's a high bar, especially for a company like Salesforce that has historically been viewed as a high-growth tech stock, not a traditional value play.
Right.
Let's see how Salesforce measures up against Warren Buffett's renowned criteria, drawing on roughly the past decade of data. We'll cover everything from valuation and cash generation to growth, balance sheet safety, and core profitability.
Okay, first up, valuation discipline. Buffett is famously patient about price, looking for undeniable bargains. How does Salesforce stack up against his preference for a price-to-earnings PE ratio of 15 or less compared to its own history?
Right, the PE test. On that critical front, it's historically been a clear fail. Salesforce's trailing PE ratio, even using its improved GAAP earnings from FY 2025, is around 26x.
Still well above 15.
Well above. And historically, for many years, its PE was often in the hundreds, or even not meaningful at all because reported earnings were so low or negative.
Right.
Investors have consistently paid a significant premium for its growth and market leadership, far exceeding Buffett's traditional valuation comfort zone. So by this stringent metric, Salesforce has almost always been perceived as expensive relative to its current earnings.
Okay. What about price to book, PB value? Buffett sometimes looks at that, aiming for 1.5 or less.
Another fail here. Salesforce's price-to-book ratio is about 2.7x currently, even after a significant stock decline from its peak a few years ago.
Still above 1.5.
Yeah. And for most of the past decade, it ranged much higher, from 5x to 10x during its high-growth years. Now, Salesforce does carry substantial intangible assets like goodwill from all those acquisitions, which inflates its book value. But this metric is quite stringent for software companies anyway, where the real value lies more in intellectual property and recurring revenue than physical assets. Salesforce simply doesn't meet Buffett's preferred 1.5x standard.
Got it. And the crucial margin of safety, paying at least 25% below your estimate of intrinsic value, leaving plenty of room for error.
This one is a bit subjective, obviously, because it depends on our intrinsic value estimate, but based on our later DCF analysis, which we'll get to.
Okay.
A conservative intrinsic value estimate might be around $205 per share. At its current price of approximately $165, the stock is about 20% below that conservative estimate.
So close to 25%, but not quite there.
Not quite there. So probably a fail on the strict 25% rule. For vital context, the stock did briefly trade down in the $130 to $150 range during the broader market downturn in late 2022. That would have offered a much better margin of safety based on that conservative value.
Right, timing matters.
It certainly does. So at its current level, it's maybe borderline undervalued on a conservative basis, but not a clear deep bargain hitting that strict 25% discount.
Okay, let's move on to cash generation and allocation, a favorite topic for value investors. How has Salesforce performed in terms of consistent positive free cash flow, FCF, and a healthy FCF to revenue ratio, say above 5%?
Okay, now this is an area where Salesforce truly shines and demonstrates its fundamental business strength. It's a resounding pass.
Or a clear pass. Okay.
Absolutely. Salesforce has consistently generated positive free cash flow year in and year out for over a decade. Even in years where its GAAP net income was negative or very low, its strong operating cash flow, thanks to upfront subscription collections, high non-cash expenses like stock-based comp, depreciation meant robust FCF.
Right, cash flow is always there.
Always there. And FCF margins have ranged impressively from 15% to sometimes as high as 33% in recent years. That's well exceeding the simple 5% criterion Buffett looks for. So both consistency and the margin threshold are met with flying colors. It's a powerful cash-generating machine.
Good to hear. What about return on retained earnings? How effectively have they converted retained profits into more earnings or market value? Buffett looks for at least 12%.
This one is complex for Salesforce, unfortunately. I'd have to mark it as inconclusive fail in the traditional Buffett sense.
Why is that?
Well, due to its history of often having negative retained earnings until very recently, and those numerous large acquisitions funded significantly by stock issuance, it really muddied the waters of organic capital deployment. It's genuinely difficult to definitively assess how well retained operating profits, not new equity capital raised from shareholders, were reinvested to generate additional earnings or market value.
Okay, the acquisitions complicate it.
They really do. While GAAP EPS has grown significantly recently, especially with the margin expansion drive, it's not purely from reinvested operating profits in the simple, compounding way Buffett typically measures. Plus, the long period of very low return on equity also makes it challenging to say it passes this specific measure in Buffett's traditional pure capital allocation sense.
Understood. Next section. Growth and predictability. Buffett famously likes steady, predictable, almost boring growth. Did Salesforce show positive and rising GAAP EPS every single year for the past 10 years?
On GAAP EPS consistency, that's a clear fail.
Fail. Okay.
Salesforce's GAAP EPS was negative or negligible in many years prior to about 2018. And it even saw significant declines more recently, for example, in FY 2023, due to one-time charges and that big restructuring.
Right.
It simply does not exhibit the monotonic, consistent, year-over-year earnings growth that Buffett prefers, where each year is predictably better than the last. Its earnings chart has been much more jagged, reflecting its aggressive growth investments and acquisition activity, not smooth at all.
Okay. What about book value per share? Did that grow by at least 10%? AGR over 10 years without any declines?
Now, this one is interesting. It's technically a pass, but with a very important caveat.
Pass with a caveat. Tell me more.
Salesforce's book value per share grew impressively from approximately $6.02 back in 2015 to around $66.25 in 2025.
Huge growth.
Yeah, that's a compound annual growth rate of roughly 27%, far above the 10% threshold. And importantly, it never declined year over year during that period.
So why the caveat?
The caveat is how it grew. This robust growth was largely fueled by issuing shares for those large acquisitions we keep mentioning. MuleSoft, Tableau, Slack, potentially Informatica. It wasn't purely organic retained earnings from operations building up the book value.
Wait, acquisitions funded by stock.
Exactly. Buffett's original intent for this metric probably leans more towards organic intrinsic value growth driven by internal reinvestment. But strictly looking at the numbers, the book value per share has indeed grown impressively and consistently.
Okay. And owners' earnings, essentially a more representative measure of free cash flow, were they positive every year? And did the owner's earnings to market cap ratio, the yield, hit at least 10%?
It's a partial pass here.
Partial pass. How so?
Salesforce's owner's earnings, which we can approximate closely with its free cash flow, have been consistently positive every single year for at least the past decade. Even when GAAP net income was negative, the cash flowed. So it passes the consistency part with flying colors.
Okay, consistent cash flow.
But the owner's earnings yield, the OE market cap ratio, currently it stands at about 7.9%, using their strong FY 2025 FCF. That's below Buffett's strict 10% hurdle.
Below 10%.
Yeah. And in earlier years, when the stock price was higher relative to cash flow, this ratio was often much lower. This indicates Salesforce was consistently priced richly relative to its actual cash generation, meaning you weren't getting that 10% initial return in terms of cash flow yield at the purchase price Buffett often looks for.
Got it. Okay, let's turn to balance sheet safety. Buffett loves a rock-solid, conservative balance sheet. Is debt to equity below his preferred 0.5 threshold, indicating minimal leverage?
Yes, that's a clear pass. Salesforce's debt-to-equity ratio is very low, currently at 0.19 as of FY 2025.
Very low.
Very low. Even at its peak, right after the big Slack acquisition, it only went up to around 0.24. This signifies a very comfortable balance sheet with minimal financial leverage. Yeah. Salesforce often opts to issue equity for its major acquisitions rather than relying solely on debt, which helps maintain this conservative capital structure.
Okay. How well does its operating income cover its interest payments? Buffett looks for interest coverage, EBIT interest of at least 3 times.
Another strong pass, mostly. Salesforce's operating income vastly exceeds its interest expense. In FY 2025, the coverage ratio was around 33x, hugely above the 3x threshold.
33 times. Yeah, that's safe.
Very safe. While it did dip lower to about 3.6x in that lean FY 2023 due to temporary factors depressing operating profit, it has generally been extremely robust and far more than sufficient. So yes, it easily passes this test, demonstrating excellent debt servicing capacity.
Good. And related to that, is interest expense a small fraction of operating income, ideally 15% or less?
There's also a pass, mostly. Interest expense is typically a very small fraction of operating income, often under 4% in strong years like FY 2024 and FY 2025.
Tiny percentage.
Very small. The only real exception was that anomalous FY 2023, where it temporarily hit 28%, because operating profit dipped so much relative to a fairly fixed interest cost. Aside from that single outlier year, Salesforce's interest burden is minimal, indicating a very strong financial position and minimal drag on its operating performance from debt costs.
Okay. Finally, for the balance sheet, a current ratio greater than 1.5. This shows ample short-term liquidity to cover immediate liabilities.
On this specific metric, it's actually a fail.
Fail. Why is that if the balance sheet is strong?
Salesforce's current ratio, current assets divided by current liabilities, has typically been around 1.0 to 1.2. Now, this is actually quite common for subscription software companies.
Okay.
And it's due to a specific accounting treatment. They carry large amounts of deferred revenue. That's cash collected up front from customers for services they'll deliver in the future. Accountants classify this deferred revenue as a current liability.
So it's cash received but not yet earned.
Exactly. So while Salesforce has substantial cash on hand, often billions, far exceeding that deferred revenue, numerically, this accounting treatment of deferred revenue as a current liability causes its current ratio to fall short of Buffett's conservative 1.5 standard. So it's not necessarily a sign of liquidity distress in their case, but it doesn't meet the strict numerical criterion.
Understood. Okay, last section of the checklist, profitability and efficiency. How effectively does the business convert its revenue into actual profits? Gross margin greater than 40%.
An easy pass, and then some. Salesforce's gross margins, as we discussed, are consistently high at 73–78%, well above 40%. This is a strong indicator of its powerful SaaS business model and its ability to scale efficiently.
Okay. Net profit margin of at least 20%.
This is currently a fail. While it's improving significantly in recent years with the efficiency push, Salesforce's GAAP net margin was approximately 16.4% in FY 2025.
Close, but not quite 20%.
Not quite 20% on a GAAP basis yet. And historically, it was often in the single digits or even near zero as the company aggressively prioritized growth over reported accounting profit. So on a GAAP basis, it has not consistently met that 20% threshold, although it's certainly trending strongly in that direction now.
Okay. Return on equity, ROE, averaging 15% or more over the past 10 years.
Another clear fail. Return on equity was very low for much of the past decade, often ranging from 0% to 3%. It only recently reached approximately 10.1% in FY 2025.
10% recently, but low historically.
Exactly. The 10-year average is well below 15%. This is partly due to that large equity base created by its acquisition strategy using stock, but it also reflects those years of low reported net income that depress the return generated on that growing equity base.
Makes sense. How about return on invested capital, ROIC, or return on total capital, ROTC, looking for at least 12% on average over 10 years. This measures how efficiently they're deploying all capital, both debt and equity.
It's also a fail. Return on invested capital has been pretty modest. It was roughly 8.5% in FY 2025 and often lower historically.
A low 12%.
Yeah. This is a common characteristic for growth companies that have made significant acquisitions resulting in large amounts of goodwill on the balance sheet. Goodwill intrinsically drags down ROIC figures calculated in the standard way. So it hasn't consistently met Buffett's standard for efficient capital utilization across all its deployed capital.
Okay. Return on assets, ROA, of at least 6%.
This one is borderline. Return on assets just hit 6.0% in FY 2025, so it barely met the criterion for that specific year.
Just squeaked by.
Just squeaked by. However, the 10-year average ROA is far below this level because, again, net income was tiny for many years while total assets grew very rapidly through acquisitions. So historically, it hasn't consistently met this 6% standard across the decade.
Okay. And finally, a low depreciation relative to gross profit, suggesting it's not an asset-heavy business. Buffett might look for 10% or less.
Here we have a strong pass. Salesforce's depreciation and amortization typically run at a lean 5–8% of its gross profit, well under the 10% mark.
Okay.
This indicates it's not an overly asset-intensive business in the traditional sense. It aligns perfectly with Buffett's preference for low capex models, where a large portion of the value and expense is tied up in human capital and intellectual property, rather than heavy machinery or physical infrastructure that depreciates quickly.
Okay, so after putting Salesforce through this rigorous, comprehensive checklist, what does this all mean? How did Salesforce ultimately perform on our Buffett-style assessment? And maybe more importantly, what does it tell us about the company's evolution?
Right, the big picture takeaway. What this all means is that Salesforce, particularly in its earlier iteration as a pure growth stock, failed many of Buffett's classic tests for being a great company at a great price.
Right. The price was often the sticking point.
Exactly. Its valuation has generally been too high for a traditional value investor's comfort, and its GAAP earnings record was quite erratic until very recently, lacking that consistent monotonic growth that Buffett famously prefers.
Right.
But the picture is much more nuanced now, and it has changed significantly.
Oh.
Salesforce scores exceptionally well on crucial underlying quality metrics that Buffett does value highly. Things like its consistently high gross margins, its powerful and consistent free cash flow generation, and its very strong low-leverage balance sheet.
Strong fundamentals underneath.
Absolutely. These are undeniable signs of a fundamentally powerful and resilient business model. Its undeniable moat, its market dominance in CRM, was built, in part, at the cost of heavy spending in its earlier growth phase, which suppressed reported GAAP profitability for years. But the key takeaway, I think, is this. While maybe not a classic Buffett stock of the past, the kind he might have bought cheap in its early days and held for decades, Salesforce is certainly moving strongly in the direction value investors appreciate. It's showing clear signs of maturity, it's focusing on improving margins, disciplined expansion, and crucially, beginning to return significant capital to shareholders.
Right, the capital return is huge.
It is, and it's worth remembering that even Berkshire Hathaway itself briefly invested in Salesforce back in 2020. That suggests an appreciation, even then, for its underlying business quality, despite some of these traditional valuation concerns we've just walked through. It's truly a company in transition, and this checklist really helps us see the magnitude and direction of that shift.
This framework provides such a clear, almost X-ray vision for analyzing a company, doesn't it? It helps us see beyond just the headlines and truly understand the DNA of the business and how it's changing. Okay, understanding the past and present, the business model, the risks, the checklist, that's all crucial context. But for investors, the real game is always about the future, isn't it? How does this deep dive, with all its insights into performance, risks, and these structural changes, translate into a potential intrinsic value for Salesforce? This is where we attempt to, well, quantify that future potential.
Exactly. This is where a discounted cash flow, or DCF, analysis becomes absolutely invaluable. It's a powerful and widely respected valuation method, though certainly not without its own limitations.
Right.
Essentially what it does is it projects Salesforce's future free cash flow, FCF, that actual cash the business generates after all expenses and reinvestments. And then it discounts that future stream of cash back to today's value to estimate an intrinsic value, usually under a few different scenarios.
Okay, discounting future cash back to the present.
Precisely. This helps us understand what the company could be worth if certain growth assumptions hold true over the long term.
So where do we begin with this projection? What's our starting point for Salesforce?
We begin with Salesforce's strong recent free cash flow performance. We'll use the $12.434 billion in FCF generated in fiscal year 2025 as our baseline, our starting point.
Okay, that $12.4 billion number.
Yeah, and for our analysis, we'll use a 10% discount rate. This is a pretty standard, reasonable hurdle rate often used for equity investments. It reflects both the time value of money, a dollar today is worth more than a dollar tomorrow, and the inherent risk involved in forecasting future business performance years out. It represents the minimum annual return an investor might typically demand from an investment like this.
10% discount rate. Got it. And then we look at different growth possibilities for that free cash flow, correct? Because forecasting the future is never a single certain path. There's always a range of outcomes.
Exactly right. Uncertainty is inherent. So we'll explore 3 distinct scenarios for FCF growth over the next decade to cover a sensible range of potential outcomes for Salesforce.
Okay, what's the first scenario? Maybe the cautious one.
First, let's consider a conservative case. This assumes very mild 5% FCF growth per year for the next 10 years, followed by a modest 2% terminal growth rate thereafter, basically forever into perpetuity.
Only 5% growth. That seems low for Salesforce.
It is intentionally low. This scenario essentially assumes Salesforce's cash flow barely grows from here, maybe due to significant market saturation finally hitting, or intensified competition really taking a bite, or perhaps prolonged economic stagnation globally. It's a cautious view.
Okay, so under that conservative 5% growth, what's the value?
Under these rather cautious assumptions, the estimated intrinsic value for Salesforce comes out to approximately $205 per share. This gives us a sort of baseline of what the company might be worth if its growth significantly decelerates from historical norms. Okay, $205 conservative value. That sets a floor, so to speak. What's the more realistic or maybe nominal outlook, given what we've learned about its strategy and those big AI bets?
Right, our nominal or base case. This assumes a more moderate, yet hopefully sustainable, 15% FCF growth per year for the next 10 years, also followed by that 2% terminal growth rate.
15% growth, that feels more plausible, maybe?
It represents a path where Salesforce leverages its potential for continued expansion through its new AI initiatives, the introduction of more industry-specific clouds, and ongoing international growth. It suggests Salesforce can maintain a healthy growth trajectory, albeit not the, 20-30% hypergrowth of its earlier years.
Okay, and the value in that nominal 15% case?
Here, the intrinsic value jumps significantly, up to around $425 per share. So you see the sensitivity to that growth rate already. This is a scenario where Salesforce maintains good, solid growth, but maybe not explosive growth. $425 nominal value. Big jump from $205. Okay, and for those who are truly bullish on Salesforce's ability to execute its AI strategy and maybe even reaccelerate growth significantly, what does the optimistic case suggest?
Right, the optimistic case. This is designed to be a highly aggressive best-case scenario. It assumes a robust 25% FCF growth per year for 10 years, followed by a slightly higher 3% terminal growth rate, reflecting maybe higher long-term inflation or growth potential.
25% growth for a decade. That's ambitious.
Highly ambitious. This implies Salesforce significantly reignites hypergrowth, perhaps driven by extraordinary AI monetization, maybe successful market share gains against competitors, and broad global expansion hitting on all cylinders.
Okay, the blue sky scenario. What's the value, then?
Under these ambitious conditions, the intrinsic value could be as high as $967 per share, almost $1,000. This would place it firmly in trillion-dollar market cap territory. This represents really the absolute upper bound of what seems conceivable if pretty much everything goes perfectly for them.
Wow, $205 conservative, $425 nominal, $967 other optimistic. These numbers are vastly different, spanning a huge range, depending entirely on our assumptions about future growth. So how does that compare to where the stock is trading today, around $165? And what does it tell us about a potential buy price for an interested investor?
That's the crucial question that ties all our analysis together, isn't it? Where does the current price fit in?
Right.
The current stock price for Salesforce is hovering around $165 per share. Now, if we apply Buffett's preferred 25% margin of safety to our most conservative intrinsic value estimate of approximately $205 per share.
Okay, 25% off $205.
The target buy price would be around $155 or lower. $205.75.
$554. So the current $165 is slightly above that conservative buy point.
Slightly above, yes. And it's notable, as we mentioned, that Salesforce did briefly trade down in that zone, specifically around $130, $150, during the broader market downturn in late 2022. That offered a more compelling entry point based on this conservative valuation. So at its current price of $165, it's slightly above this conservative margin of safety threshold. It implies perhaps modest undervaluation relative to a cautious outlook, but maybe not a deep bargain by very strict value investing standards.
Okay. But what if you believe more in the nominal case?
Well, if an investor believes in a growth trajectory closer to our nominal case, with that intrinsic value of $425 per share, then the stock at $165 would appear significantly undervalued.
Yeah, $165 looks cheap compared to $425.
Exactly. In that more optimistic 15% growth scenario, the current price would already offer a substantial margin of safety, making it potentially a very attractive opportunity for those confident in Salesforce's future execution and AI strategy paying off.
This really highlights how incredibly sensitive intrinsic value calculations are to our assumptions about future growth and profitability, doesn't it? It shows why truly understanding those underlying assumptions and having a well-reasoned basis for them is absolutely crucial for any investor making a decision. It's not just about the number, but the story behind the number.
Absolutely, you've put it perfectly. It's vital to remember that these valuations are based on specific assumptions about future growth, future margins, discount rates, and they are inherently forward-looking and absolutely not guaranteed.
Right.
The actual market price will respond to countless unforeseeable factors: competitive shifts, broader economic conditions, changes in investor sentiment, execution successes or failures. This DCF analysis is a powerful tool to gauge what a stock might be worth under different conditions, helping you to understand the potential upside or downside based on your own reasoned beliefs about the future. It's a foundational piece of the puzzle, but it should never be the only piece you look at.
Okay, before we wrap up, just a quick reminder for everyone listening.
Disclaimer. All financial analysis presented here is for informational and educational purposes only and does not constitute investment advice. It's based on publicly available sources and our own interpretations, which may differ from others.
Please conduct your own thorough due diligence before making any investment decisions. Your financial situation and risk tolerance are unique.
And if you enjoyed this deep dive and want to hear more, you can subscribe to us on Apple Podcasts or Spotify. Just search for Deep Value Investing.
We also often include a list of relevant books or resources in the episode description if you want to dig even deeper yourself. #outro. Well, what a deep dive this has been into Salesforce, CRM. We've unpacked their robust recent earnings, dissected that powerful software as a service model, explored both the temporary macroeconomic headwinds and those significant longer-term structural risks they face. And we delved into their evolving cost structure and leadership's pretty clear strategic pivot toward efficiency and profitability. We saw firsthand how fierce shareholder activism fundamentally reshaped their capital allocation strategy, leading to those unprecedented share buybacks and the initiation of their first ever cash dividend.
And we subjected Salesforce to that rigorous Buffett-style checklist. While it didn't pass every single traditional value investing test, especially looking back at its historical valuation and sometimes erratic per-share earnings growth in its earlier phases, its undeniable business fundamentals stood out. Those consistently high gross margins, the powerful free cash flow generation year after year, and that rock-solid balance sheet. These are truly compelling quality factors. Salesforce is genuinely maturing, transitioning from that relentless growth-at-all-costs company to one seemingly focused on disciplined, profitable expansion and, increasingly, returning capital directly to its shareholders. The company is now making a profound, audacious bet on AI to drive its next growth cycle, really positioning itself for the future of enterprise software.
So as Salesforce continues to navigate this intense competition and an ever-evolving tech landscape, making that bold wager on AI to fuel its next phase of growth, and as it seems committed now to consistently returning capital to shareholders, the real question for you, our informed listener, isn't just what Salesforce is doing. It's whether it can truly maintain this new, maybe delicate balance of innovation and profitability to become a consistent long-term compounder of value. And perhaps more importantly for your own portfolio, at what price you are willing to acquire that potential future value today, factoring in your own reasonable expectations for their growth and execution.
Absolutely. This deep dive, using a framework that helps us assess not just the company, but maybe the broader market temperature and a company's intrinsic value, is precisely how you can get better at spotting those potential opportunities and understanding a company's true worth beyond the daily noise. We hope this has given you plenty to mull over and maybe a fresh, critical perspective on this tech giant.
Until next time, keep digging deeper and always stay curious.